This video will tell you all you need to know about mutual funds. Before we begin, please note that mutual funds are subject to market risks and make sure to read all the scheme related documents carefully. Furthermore, the video content has been made for informational and educational purposes only. Nothing contained in this video shall constitute or be deemed to constitute an advice. Always seek the advice of a professional with any questions you may have regarding your financial decisions. Before we get started, here's a brief on what we will be discussing today. Way to invest in mutual funds, tax treatment of mutual funds, debt funds versus fixed deposits, ELSs versus PPF, why mutual funds are a smart option, and the benefits that no one tells you about.
Now let's look at what SIP and lump sum investing are. First is SIP. So SIP is like how we do a recurring deposit in the bank. It's a recurring deposit in the mutual fund. It inculcates the discipline of savings and makes it a habit. So what it primarily does is you will set an instruction to debit your bank account on a particular date every month to set aside that amount of money towards the mutual fund as savings. Now, from a minimum amount standpoint, it is as minimum as 500 and it's convenient based on how much amount you're willing to spare. And when an SIP is done over a long period of time, it helps in rupee cost averaging because every month based on the market price that's available, you will be buying it at different points. And also you can run SIPs for goal-based investments where you know that you want to dedicate a particular fund for a goal. And also year on year, you can also add up to your SIP and do incremental SIPs. With regards to lump sum, it's a one-time investment that you make for people who don't have regular cash flows or who can also come across some surplus savings at a particular time of the year. This works well. This can also be invested to average costs in your existing SIP portfolio. And it's important to actually channel your lump sums during low points of the market and during adverse situations. STP is systematic transfer plan. This is basically an instruction where you set up where the funds are transferred from a particular fund A to another particular fund B over a specific period of time. This is a strategy which you can use that will help you in averaging costs over a period of time. And you can use this strategy when you are channelizing your lump sum investments. SWP is systematic withdrawal plan. This is primarily used for people who already have an existing corpus invested and who would like a payout from that. So it will redeem your existing investments from your mutual funds invested. And when you're redeeming over a period of time, again, it helps in cost averaging. And it's meant for somebody who's looking for an income from the corpus they have saved up.
Now we look at the tax treatment of mutual funds. For equity, short term means units that are held for less than a year, whereas for debt, this means units that are held for less than 3 years. The converse applies to the definition of long term. When we look at gains, for equity mutual funds, short term gains are taxed at 15%, whereas for debt funds, this is taxed at the investor's slab rate. For long-term capital gains, equity is 10% and for debt, this is 20% with indexation. We'll talk a little bit about indexation later. And we have dividend distribution tax. Currently, this is paid by the AMC. For equity, this is about 11.64% and for debt, this is about 29%. From April 1st, 2020, dividend distribution tax will not be paid by the AMC and will be paid by the investor and at the investor's slab rate for both equity and debt schemes. We'll now compare the investment between a debt mutual fund and a fixed deposit. In terms of taxation, tax is deducted at source for FDs but not for debt mutual funds. The tax is applicable on the interest earned every year in an FD, whereas this is applicable only on the capital gains when they are realized. The tax rate, when the investment is less than 3 years old, for an FD would be the investor's slab rate, and the same applies for a debt mutual fund. However, if an investment is more than 3 years old, in a debt mutual fund, the tax slab is 20% with indexation. What is indexation? Indexation basically adjusts the purchase cost with inflation, and when you do this, capital gains are reduced. And when capital gains are reduced, the tax payable also reduces. Now, if you were to invest 10 lakhs with a 7% return from a fixed deposit and the same return with a debt mutual fund, and inflation over a period of 3 years was expected to be at 5%, an investor may make 1.5% more in the highest tax bracket by choosing a debt mutual fund over a fixed deposit. Now we look at ELSS versus PPF. When we look at the parameter of the lock-in period, ELSS has the shortest lock-in period of 3 years, whereas PPF has a lock-in period of 15 years. The minimum investment to a ELSS scheme depends on the AMC and there is no maximum limit. Whereas for PPF, a minimum contribution of 500 rupees per year is mandatory, and this contribution is capped at 1.5 lakhs per annum per account. In terms of continuing this investment, ELSS is very flexible. You could opt for an SIP or a lump sum. You could do a one-time investment and stop. Whereas for PPF, there is a commitment of 15 years. When it comes to renewal, again, ELSS is flexible, but PPF can be renewed for a block of 5 years only, and that can be done any number of times. In terms of tax treatment, ELSS being an equity mutual fund is subject to 10% capital gains, and PPF is exempt from tax. In terms of returns, ELSS returns are market linked, whereas PPF returns are fixed from time to time, and currently this is at around 7.9%.
So, what actually makes mutual funds a smart investment option? There is professional management because you will start working with a professional to help you understand this space better. And secondly, every fund is managed by a fund manager, which ensures a second degree of management. It's pocket friendly. It helps you make an investment for as minimum as 500 and it goes up. So it doesn't stress you out on your savings. It's a well-regulated space as SEBI and AMFI are ensuring everything to protect investors and make the whole model transparent and investor-friendly. From a liquidity standpoint, mutual funds are an extremely liquid assets. Based on the type of mutual fund that you have invested in, money will be available back in your bank account over 1 to 3 working days. There are a variety of options based on what you would require. So for people who already have an existing wealth created, it could have like a payout option where dividends come to support their monthly cash flows. Or it could also have a growth option where for people who are young and who are looking to build wealth, everything grows in growth and it helps in compounding. It's also suitable for all investors as there are multiple instruments ranging from low risk to high risk. So there is a space for everyone to stay invested. From an asset allocation standpoint, there are multiple funds that invest across various assets. So even say if you're looking at something like wanting to buy gold, there might be making or wastage charges included when you buy physical gold. But there are gold-based funds available in the mutual fund space which will help you take the appreciation of the asset class but not necessarily have the added charges, or even real estate based mutual funds which will help you get a portion of the money exposed to real estate as an asset class but not have you buy the entire property. Mutual funds are also flexible, so it gives you an option of either opting for the SIP route or the lump sum route or also a mix of both. From a transparency point of view, you as an investor have the entire access to what mutual funds you want to invest in. With SEBI's recategorization, you know what exactly the fund is investing in and you know how much of your money is put in and what it's doing today. And lastly, it's also tax efficient. Based on the tax slab that you fall under, there could be alternate products that will make the entire taxable income more efficient. Also, it's important to note that you need someone to guide you through this entire process, as we had said before, that not all funds are the same.
Now that we have seen what mutual funds are, here are some benefits that no one tells you about. Mutual funds are highly liquid as the redemptions are settled by the AMC. Every type of risk profile will have a suitable mutual fund, which can be selected based on the individual's risk capacity and their financial goals. Mutual funds invest in all sorts of asset classes, such as equity, debt, and gold, and they also give you the option of mixing these asset classes into a particular fund. The industry is well regulated by two regulators, SEBI as well as AMFI. Finally, mutual funds, when allowed to grow, give you the power of compounding and can truly multiply wealth. Before we conclude, we would like to leave you with a quote by Howard Marks. No asset class or investments has the birthright of high return. An asset is attractive only if it's priced right. Get your asset allocation right with a marathon SIP. To know more on how you could start your investments, get in touch with us. Thank you.